Hi, I'm Mal and I'm from the Money Study, bringing you another episode of our You and Your Superannuation series there. And this is episode number 10, talking about how to choose that investment and create your portfolio effectively inside your super fund so that it suits you and your circumstances. Before we kick off with information, there's the disclaimer, facts and figures. It's all about information, it's not advice in today's session. It's surprising the number of people who don't know that they can't, that they don't know that they can even move their investments inside their super fund. People blame their super fund when it goes backwards, when the share market might have a bit of a hiccup or fall. And they say, now my super fund's hopeless, it's losing me money. Well, no, it's the investment that you've got inside the super fund that is the issue. I'm not saying your super fund may be good or bad, it's just the fact that if you've chosen a very, very aggressive, high risk style investment and the share market falls, you will lose money. There's no two ways about it, because your exposure to things like shares could be very, very high. Most super funds have what we call pre-mixed options, and these are the sort of standard 5 here, having an aggressive account, a high growth account, a super balanced account. That's generally speaking the default option. Then these things called income focused or conservative accounts, stable and cash. They're the sort of typical top 5 that you would have there. They might have slightly different names, but basically what they do is they're going from an aggressive end of the portfolio, meaning you've got a lot of things that are like shares in your portfolio. So you might have international shares and Australian shares. You might have even some currency trading and hedging and all sorts of other things going on. And the big chunk, generally speaking, with an aggressive account, probably somewhere at least between 80 to 90% of your investment, may even be 95% or even higher in some funds at certain times, where you've got fully loaded up pretty much on shares. A balanced account, generally speaking, 65 to 75% in that sort of area in things like shares, these growth assets. Conservative, even conservative funds, a lot of conservative funds still have around about 40% of it in shares, or things like shares, these growth assets, and the remaining money is then in the what we could normally call the conservative style options, things like cash, bonds, fixed interest and so forth. So you, even with a conservative fund, you still can expect to see losses. And they could be reasonable losses in a very severe downturn of the market if you've got 40% of your portfolio is in the market. Stable fund, basically that's pretty much what they're trying to do with the name. They're trying to keep your returns fairly stable. They're not swinging wildly. They just sort of ticks along, and hopefully in a positive direction, because you've only got around about 20% of your investments are in things like shares, the growth assets, and everything else is in those low risk things like cash and so forth. Now, of course, some of the stable and conservative funds didn't do very well in the last year or two when you would expect them to, in a regard that things were a bit volatile, the markets were playing up. Then why wasn't my conservative fund doing better? The reason being is that a lot of conservative funds have a big chunk of their investment in things like bonds. Now, a bond is a debt, and it could be a government bond where you've basically lent the government some money and they give you an interest rate on it and so forth. And if you hold it to maturity, you get your money back. But if you've got a bond, and a few years ago, because interest rates were so low, you might have had some 1%, 2% bonds in your portfolio, in the conservative area. And then interest rates went up. Now, if all of a sudden you can get 3% and 4% bonds quite easily, who wants your 1 or 2% bond? And so if you then sell, and this is what these funds are doing, they're buying and selling bonds all the time to try and squeeze out the best return they can, then effectively you'll be losing money. So bonds didn't perform very well. They don't perform well when interest rates are going up, and especially with the amount of increases that we had. Now, of course, as the interest rates start to slow down here, and the expectation is that we're sort of hitting a peak here, and here we are in January of 2024, that our bonds will start to generate, and our cash components and our stable, these more conservative options, we will start to see some decent returns from cash and conservative options. As the cash rate goes up, we're going to start to get, hopefully, some 3s and 4s, and there's some cash accounts already offering over 5% in the bank. So we could expect our cash options and conservative options to start giving us a reasonable return there with a pretty lower risk. So it comes down to, if the interest rates start to fall, then of course bonds can actually do very well, because if you've got a 5% bonds and all of a sudden interest rates go down, now you can only buy 3% bonds, everybody wants your 5%, so you sell it at a higher level. So bonds sort of work a little bit back to front to what the interest rates are doing there. And of course, so it comes down to, if we can have a mixture, and that's what we're trying to do here, having a mixture between shares and bonds and cash and infrastructure and so forth, so that if one part of the portfolio is not doing so well, the other part may indeed be doing well. And then of course it comes down to how old we are, our risk profile, and all the other issues that people talk about with risk. So you've got to look at what the fund earns, but you've certainly got to look at what sort of risk you're taking on. Someone who's very young and got 40 years ahead of them in their super fund could, generally speaking, take on a lot more risk, because yes, things will fall, but things will come back, and so it goes on. You've got time on your side for the investment to do well. Also, the fact is someone starting out might only have $10,000 in their super fund, and if the super fund loses 20%, well, they've only lost $2,000. But if you've got $1 million and you lose 20%, you just lost $200,000, and so it goes on. So generally speaking, younger people can afford to take on more risk. The older we get, the closer we get to retirement. Generally speaking, not quite the case. But you see, we're all different. There are people who are quite happy to take on risk, thinking, yep, I know what's going on. Yes, I believe everything's okay. I can sleep at night, no problem at all. Where other people are basically panicking any time there's even a slight downturn. So we're all different. But it's a case of making sure your portfolio matches you and matches what you're prepared to do and what you're trying to achieve, your age and so forth. So we can all have different portfolios, that's for sure. And you're allowed to mix and match between these portfolios. Now, your super fund may have more than 5. Some of them have lots of other options, as I explained in one of the previous sessions here. And of course, your fund might even have less. Some of the funds I know, like the PSSAP, for instance, only got 4 options. They don't even have a stable option, and so it goes on. Not to say that that's bad, because you can mix and match, meaning that if you wanted your portfolio to be a little less aggressive than you've already got, well, then you can just change the percentages of what you've got in the various different options. So you might have had a balanced account, that's the default option. If you don't choose, that's what they would normally put you into. And then if you decide to change it, well, you can say, okay, I'm a bit worried. I might have 20-30% of my portfolio now in conservative, and so it goes on. So you can have any percentages you like in the various different options, as long as it obviously adds up to 100% there. Not with most funds. With most funds, you can do this online, and you can normally move your money pretty much within 24 hours. So you can go online, find the investment choice and investment switch page on your website, dial up the percentage that you want in the various different options, and hit the submit button. If you do more than twice in a year, so you can normally do it twice in a year, most super funds will then start to charge you if you do it more than twice a year. Now, normally, $20 or something like that would be the fee. If you exceed the twice in a year, Now, even I don't mind paying $20 if it means that I can still move my fund, which, if it makes sense to do so, to make myself some money or protect myself from losing money there. When you hit the link to go into switch, it will normally come up with a question saying, do you want to switch existing, do you want to switch future, or do you want to switch both? Now what that means is that if you just tick the box that says existing, you are moving all of the money that's in your current account at the moment. So you've got 400,000 sitting in your super fund. If you hit the existing, that 400,000 will be moved to your new portfolio. If you just tick the box that says future, your money that's in the super fund at the moment will just stay where it is, but any future contributions that you put in, they will go into the new portfolio. And some people do it this way in regard that they say, okay, I've got a balanced account, but I'm getting older. What I might do here is just make all my contributions in the future go into a conservative option. So bit by bit by bit by bit, I am watering down my balanced portfolio to bring it down to, heading towards the more conservative option. Or might be the other way around. The share market has fallen. You're in a balanced account. You're a bit worried about moving it into something aggressive to take advantage of the market perhaps rebounding. You're not brave enough to move your existing portfolio, but you could indeed make your contributions go into the more aggressive situation to buy the market while it's cheaper, as it's then, in theory, going up. So you've got a fair bit of control with most of these funds on what you've got, what you're going to do. Now, because if you click the button that says both, you will move what you've got and all future contributions as well. Most funds will allow you to do it via form, but generally speaking, just jump online, quick and easy, just dial up the percentages of what you need and hit the submit button. It's always a good idea, however, before you move from one sort of option to another, that you really get a good perspective of what your fund is all about, what do the different terminology do. And most of the funds will offer you, the pie charts. If you go into the investment options, they will give a little bit of a blurb as to what it's all about and what that particular option is trying to achieve. And it usually gives you a bit of a breakdown on what you've got there. Now you can see this is a balanced option in a particular fund here, but it's got equities. Now equity is effectively shares in companies and so forth. This one's got about 60% just in the shares, and yet this is a balanced option. And you've still got things like property, which could be listed property, which will certainly move when with the markets and things are playing up. And then you've got nearly another 7% in alternatives, which some of that can certainly be more higher risk. So certainly don't just look at the fact that equity. If you're looking at the more safer, conservative components of that, really, the cash and the fixed interest would be sort of what you're looking at in that lower risk option, generally speaking. Sometimes infrastructure can be classified as lower risk because it's literally things like airports, tollways, old age homes, things that just sort of tend to tick along, irrespective of what the markets are doing. But they certainly can vary because they're still companies, generally speaking, can move with share market movement. This was a chart that I found on the PSSAP website. And they're basically giving us a bit of an idea here as to what you could normally expect from the different options. And what they're saying there is if you're in a balanced option, that over 20 years, you could indeed expect to see your account have negative returns, go backwards 3 or 4 times over 20 years. 3 or 4 times over 20 years. And of course, an aggressive account, up to 6 times, 6 years out of 20. So nearly a third of the time, you could be seeing this thing go backwards. Now, of course, when things are going well, it generally speaking does very well. But are you the sort of person that could cope? Just imagine if you had 3 or 4 negative years in a row. how would you feel, and what would you be doing? So, it's just got to come down to you being comfortable with what you've got. And you can see there the risk labels, obviously cash, very low risk because effectively, it's in cash. Now, even there, they're saying you could expect to see cash go backwards 6 months out of 20 years, obviously through some interest rate drama or something like that. But generally speaking, very low risk. You're protecting your money, obviously, by being in cash. But as I say, it's a bit like having most super funds, a bit like a 30-day term deposit. That's sort of like the rates that you would probably get on a cash account there. But you can see, that your super balance, which most of you are going to be in, is indeed medium to high. And for some of you, I think you probably more would just, with the exposure that you've got, just understand that it's not as balanced as people try and make it out to be. I don't like the terminology balance, because generally speaking, people think balance means I've got half of my money is in risky stuff and half of it's in more conservative. Not if you've got 65 to 75% of your money is in those more risky growth assets there. So just understand the different terminology. Have a look at the pie charts to understand really how much risk are you indeed taking on. Now, I don't mean to pick on the PSSAP, it's not my intention, but it's just a case that a lot of my clients are indeed public servants and are using the fund. 2023, yep, they did very well. Their returns on their performance for the year, you can see there that the balanced account did 9%. And that actually beat a lot of the bigger industry super funds this year. They certainly did a stellar job in this 22-23 financial year. And their growth account, their aggressive account there, 11.5%, very good returns. But as I say, I'm not really fussed what a fund does in 1 year. I'd much rather look at what it's done over 10. And still, fairly reasonable returns on a balanced account there of over 7%. And if you can get 7% compounding for 10 years, your money will double even without any contributions. And it's what they call the rule of 72. So basically what it boils down to, if you get 7% on your money for 10 years, your money will double without even any contributions. If you get 10%, your money will double in 7 years without any contributions, and so it goes on. Have a look, Google the rule of 72 to sort of understand what sort of percentage do I need to double my money. But remembering that's without any contributions with you. If you're contributing and your employer's contributing, then obviously that's helping our growth as well. As I said, 7.27 for 10-year period, not too bad. Some of their larger industry funds, a couple of the really well-known ones up there, 8.6 over 10. So look, 8.6 compared to 7.2, people say, it's only 1.5%. But 1.5% compounding, 1.5% compounding over 10, 20, 30 years, that does indeed make a bit of a difference. So if you listen to my previous episode on consolidation and rolling of funds, and all the things we look at, we talk about returns, that's one of the reasons that we're looking into of the fund that we've actually got. So again, what's your time frame? Are you young? Have you got plenty of time for these things to do what you need to do? I do get people, unfortunately, who are old and with but they haven't got quite enough, and they take on risk to try and play catch up. Now, it can work, obviously. If you take on the extra risk, if things go well, all good. But if things don't go well, we could indeed start to lose the small amount that we've already got. So we've got to take risk into account just as much as we take into account the return. The two things are tied together there. This was also, I found this on the PSSAP website, is what they suggested, that if you've only got 1 or 3 years before you need money, now this is just, this is investing 101 effectively, that if you need your money, and dare say your total money within 3 years, Doesn't matter whether you're a gung-ho or you're a very conservative person. The time frame is so short that if you did indeed have a market downturn, you don't have enough time on your side for it to rebound. So if you imagine you're saving, for a deposit on a house, and you want to buy this house in 2 or 3 years' time, you can't afford to put it into the share market, hoping for greater returns, because you could find that in 3 years that you certainly have less money. So this risk thing is certainly knocks you over the head a bit to bring you back to reality. And of course, yes, if you've got a 7-year plus time frame, basically suggesting that as long as you're not worried about it, having a growth or an aggressive account is quite okay. Balanced if you're a bit worried. I mean, this is where your personality comes into it. In theory, with 7 years, if something happened, you've got a bit of time on your side. Mind you, if you look at what the Australian market did in 2007 and collapsed into 2008-9, it basically didn't get back to where it was, the level of the market, until I think it was 2019, I think it was. So 12 years later, before the market rebounded from that. Obviously, there would have been dividends and other income being paid, but as far as the actual value of the market is concerned, it took quite some time to rebound there. But of course, if you're a nervous Nelly and you can't sleep even to see even lose a dollar, well, then you really don't have a lot of options. Conservative or cash is certainly one of the options that you do need to be looking at there. We don't have a crystal ball. We're no smarter than certainly than the investment teams that are doing all this work. So it's a case of you can't say to us, what's the market going to do next Wednesday? I've got no idea. I've got my own personal idea. But we're not going to turn around and say to you, yeah, the market's going to fall tomorrow. Make sure you move your money. And the interesting thing about that is that even if you were in a balanced account, you've got the investment team of your fund making changes all the time. They really can't, even if they believe the share market was going to crash the following day, are not allowed to take all of your money and stick it into a cash account, even if that's what they thought, because as a balanced investor, you have got certain parameters of how much money you want in shares and so forth. So there are limitations of what your investment managers can do inside your super fund. So generally speaking, if you've got a more risky option, the market falls, you will indeed lose money. That's not to scare you off. What I'm trying to do here is help you try to understand what you've got, the risk you're taking on, the generally speaking, the rewards that you should be aiming for, what your fund is doing, find out what it's doing, and then start to analyse really what do you want to do, what are you trying to do, what can you do without losing sleep at night. We are certainly here to help you, guide you through all of that mess, but we'll never ever tell you you should move your money from one option to another. We can discuss these options and what it means for someone in your situation. But hopefully that will help. It's a bit convoluted and a bit longer than probably what I was imagining in that topic, but it is certainly more involved than people try to make it. Hopefully we'll talk again on another episode.